Welcome to Boring Currency. Now, let's begin what just unfolded. CME accomplished its objective. March silver open interest collapsed to 10,126 contracts. That's down 11,356 from the prior session, over a 50% reduction in a single day. They went from facing potential delivery exposure on more than 110 million ounces to just 52.6 million. Then the halt arrived. During Wednesday's metals pause, 31,128 contracts traded while retail was entirely sidelined. When markets reopened, silver had already been crushed $4 lower. Then came another wave. And another. Wave after wave until price was driven nearly $6 down, from 91 to 85, in what looked like coordinated pressure, not organic liquidation. Peter Brandt has shifted tone. He's now publicly discussing potential legal action against CME. When a veteran trader known for pure chart discipline admits the structure looks compromised, you know Wednesday's intervention was impossible to ignore. In the last video, I highlighted the 150 EMA on the hourly chart as a confluence zone. Price fell to 85 and bounced precisely there. Review it yourself, the video and the chart. I didn't predict a bounce. I gave you the level. That's tape reading education. You've learned more from one EMA on this channel than most paid mentors will ever reveal. Now your assignment. Remember the swing failure pattern I pointed out at 72 when panic ruled and zero was trending? Mark Tuesday's 9 a.m. low with a horizontal line and extend it forward. Price tagged the 150 EMA, purge that low, and close the candle significantly higher. That's a swing failure pattern. From 85, price reacted and climbed back toward 88. Patterns form on every time frame. Daily, hourly, irrelevant. The key is observation. I'm not forecasting direction. I'm interpreting what price did at a decisive level. That's the divide between guessing and reading the tape. The setup forms. Price reacts. Confirmation appears. You observe. Repeat this across futures, forex, crypto, metals, and you'll start identifying these structures before they finish developing. The purge of a meaningful low followed by upward expansion. It repeats everywhere with mechanical precision. Almost like invisible hands guide it. That implication speaks for itself. To everyone asking about copper, crypto, futures, I'm tracking it all. 2026, I'll deploy frameworks you haven't encountered. Systems these so-called educators don't even realize exist. I'll expose how engineered every market truly is. I don't want your money. I don't need praise or titles. Show up. Verify what I present. Tag me on X so I can review your work. A genuine hunger to learn. That's the only currency I require. That's what keeps me building here. But understand this clearly. None of this guarantees all-time highs from here. This is tape reading education, interpreting the move, not front-running it. Now here's what that rug pull cost them. CME survives another month. They reduced March delivery strain enough to get through. But whatever credibility remained took another hit. When the same exchange executes identical disruption during November delivery and again in March, even mainstream traders start connecting dots. Last time they pulled this maneuver was November 28th. What followed? Silver rallied 120% over the next 60 days. Not because manipulation vanished, but because desperation at that magnitude reveals underlying pressure is authentic. When intervention becomes this overt, you're watching a system struggling to reconcile paper claims with physical supply. Edwin Lefebvre detailed this behavior in Reminiscences of a Stock Operator. Insiders engineered violent shakeouts to eject weak hands before positioning for the real move. Wednesday mirrored that script, effective in flushing tourists, noise against structural imbalance. While paper momentum reset, physical kept flowing. COMEX vault figures just updated. While paper momentum reset, physical kept flowing. COMEX vault figures just updated. 1.3 million ounces drained during Wednesday's halt. 218,000 adjusted out of Brinks registered. 624,000 withdrawn from HSBC. 25,000 from JP Morgan. 619,000 from MTB. Registered silver now stands at 86.13 million ounces. Total COMEX inventory sits at 64 million. Coverage ratio near 60. Registered metal covers just 60% of a single month's open interest. Registered divided by open interest equals 0.14. For every 10 contracts, only 1.4 have physical backing. And here's the number almost nobody highlights. 54.51 million ounces gone in 30 days. A 13% inventory contraction in 1 month. Paper price can be managed. Metal exiting vaults cannot be fabricated. Shanghai remains near 97 spot, 100 futures. Western spot trades around 88. A $9 premium persists despite halts and engineered breakdowns. That's not fleeting arbitrage, that's structural divergence. Now consider India. Their securities regulator approved $385 billion in actively managed equity funds to allocate up to 35% into gold and silver instruments. That's institutional capital rotating into hard assets at scale. Starting April 1st, India's regulator instructed mutual funds to value physical metals using domestic exchange spot prices, not LBMA benchmarks. They're decoupling valuation from London pricing. This removes currency conversion complexities, transport adjustments, duties, and Western pricing influence. As capital flows east, price discovery shifts with it. When a $385 billion market says it will use its own exchange prices over London's benchmark, you're witnessing global financial architecture evolving. Now revisit Jane Street. In Q4, they added 20.6 million SLV shares, becoming the largest holder with a $1.3 billion position. But there's a deeper layer. The Jane Street lawsuit revealed mechanics far more revealing than the crypto winter headlines suggested. A former Terraform intern, Bryce Pratt, allegedly created a private group chat sharing material non-public information. May 7, 2022, Terraform quietly withdrew $150 million from Curve's 3 pool. Within minutes, a Jane Street wallet removed $85 million. Combined drain, $235 million before broader awareness. The peg destabilized. 6 days later, $40 billion evaporated. Then discounted asset offers followed. Insider positioning before collapse, opportunistic bids after devastation. This marks the second lawsuit from Terraform's administrator. Jump Trading was sued for $4 billion in December over similar allegations. 2 sophisticated firms, alleged coordination, retail absorbing losses. Why does this matter for metals? Because concentrated positioning, information asymmetry, coordinated action under stress, those dynamics aren't crypto-specific. They're structural. When a Manhattan federal judge debates whether market making crossed into market manipulation, remember, similar concentration exists in silver. Jane Street holds $1.3 billion in SLV, while retail gets halted out. Same blueprint, different asset. Now, honesty. What could delay this? CME can continue rolling contracts into May and July. They demonstrated willingness to halt trading and flush specs. Shanghai premiums could narrow if demand cools. They could repeat this maneuver next delivery cycle. That's within their capacity. Here's what isn't. 1.3 million ounces don't drain during a halt when confidence is intact. Shanghai premiums don't persist at $9 if arbitrage is effortless. India doesn't detach from LBMA expecting Western dominance to endure. Coverage ratios don't compress to 60 in abundance. Open interest at 120,088 contracts against 86 million registered ounces reveals math tension participants recognize. These are documented, verifiable facts, not speculation. Here's the summary. March delivery pressure reduced over 50%. Specs flushed. Momentum cracked. Silver still defends 88 with a $9 Shanghai premium, while 54 million ounces vanished in 30 days. India unlocked $385 billion for hard asset rotation and decoupled price benchmarks starting April. Coverage ratio near 60 signals imbalance. Last November's similar disruption preceded a 120% advance. Not predicting repetition, observing that visible desperation often precedes significant repricing. This is financial warfare education, not investment advice. Mainstream narratives encourage distraction. Institutional math unfolding in real time demands attention. Invest with discipline, not emotion. And if you want more sharp updates like this on boring currency, subscribe and comment boring currency so I know you're part of the community. This video is for education and discussion only. I'm not your financial advisor. I don't know your personal situation, and nothing here is a buy or sell recommendation. Do your own research and think for yourself.